Thank you for joining us on this non-jobs day, Jobs Day. We get no government primary economic data because of the shutdown right now. So let me start by asking, if that continues, as a member of the Open Market Committee, would you feel comfortable voting for a significant cut in interest rates if you don't have data on employment and on inflation?
Good morning, and thanks for having me. Look, I think it's important to recognize, first of all, that as you're pointing out, access to high-quality data is of utmost importance when making monetary policy decisions. However, it's also the case that we don't make monetary policy decisions every day, right? The FOMC meets to vote once every 6 weeks or so. Now, I think that's a bit longer than most shutdowns have historically lasted, so I'm hopeful that we'll get the data by the time we actually have to make the decision.
Well, despite what the president says, as you well know, inflation is rising. Food prices are up, gasoline prices higher than when he took office. Those are the prices that Americans notice and hate. So isn't it a risk to cut rates significantly in a regime where inflation is rising?
So my view is that policy should be forward-looking, right? I don't necessarily have a forecast that those items are going to continue rising. In fact, I think that a lot of them will actually reverse somewhat. But for my process, what matters most of all is the cost of housing, because that is the single largest component of the inflation process. And it's also one of the things that people notice the most. They notice when their rent surges. They notice when the cost of shelter increases. And that's why it gets the largest weight in the inflation indices. And my expectation is that we've just experienced, the biggest population shocks to both the upside and the downside in my lifetime, and I think in most people's lifetimes. And to me, it would be very surprising if that left no lingering trace on the price of shelter. And so I am expecting a significant disinflation to the services component of the inflation indices driven by shelter, which is affected to an extent by changes in population growth.
Well, we were talking before we came on about your view of R-star, the neutral rate. We've got inflation running at basically 3%. You've got unemployment at 4.3%, which is historically very low. The Atlanta Fed says we're growing 3.8% or grew 3.8% in the third quarter. There's no economic model that I know of that would get you to a near zero neutral rate with those kind of conditions.
Yeah, so first of all, I have seen some folks argue that they think that my conception of the neutral rate is zero. That's not the case. I think that's a misreading of the speech. If you read the speech carefully, you'll notice that I do a weighted average of a model-implied ex-ante and a market-implied ex-ante rate, and it comes to about a half. And that's consistent with the dot that I put down on the statement, on the summary of economic projections. And so I basically thought, sort of going into things last year, there were all these policies that were pushing R-star higher, like the highest population growth we'd seen in decades, the largest sustainable fiscal deficits we'd seen, sustained fiscal deficits we'd seen in a really long time. Those are pushing R-star higher. So last year I really thought it was at the top of the range of where everyone else in the committee thought it was, and I think it's now come down this year to the bottom end of the range of where everyone else thinks it is.
But you can't model that.
What do you mean I can't model that?
The models, if you put in the numbers that we have right now, it wouldn't spit out near zero or 0.5%.
Oh, real rate. Well, no, but what I've done is modeled my expectations for inflation based on the changes that I see happening from housing, as we talked about a moment ago. I've modeled out changes to the output gap that I expect to see from policies that expand the supply side of the economy and therefore expand potential output faster than they would expand actual output. And some policies that we've seen enacted over the course of this year would push out potential and actual by the same amount or bring in potential and actual by the same amount. Other policies would push out one more than the other. And so for an example of one that would push out one more than the other would be deregulation, right? I think that the regulatory state has been being peeled back over the course of this year, and all indications are that will accelerate, particularly as the pace of confirmations of appointees has just picked up as well. That, in my mind, will accelerate the pace of deregulation, too. And when you remove regulations, you expand the potential output of the economy faster than actual output. And so that creates a positive output gap.